Thank you for joining Minds of Commercial Real Estate. Today we have Gino Barbaro again. Gino, thank you for coming back on the show.
Amiar, thank you for having me on. And I know we're going to be talking about what's going on in the market. And I love the title of your show, The Minds of Commercial Real Estate, because I think we're losing our minds right now, aren't we, in this market?
It is definitely a very unique market, and a lot of people are losing the mind just trying to put different puzzles together to keep
Yes.
their portfolios going.
Yes.
You got what I want, got what I want. You give me just one look and you know I'm good to go. You know I'm good to go.
It's interesting because Mark Twain said that history doesn't repeat, but it rhymes. And that's what's going on in this market cycle. It doesn't feel like the last market cycle back in 2011 and 12. It doesn't repeat exactly, but it does have signs of rhythm to what happened in that last down market cycle. And it's really interesting now because the demographics have shifted from 15 years ago. 15 years ago, people weren't moving to the Southeast in droves. They weren't moving to Texas in droves. They weren't moving to the Sun Belt in droves. They were still central in the Northeast and California. Those were really, to me, the power centers. In this part of the market cycle, there's been such an overbuilding and oversupply of the assets in those markets that there's just so many deliveries coming on. And the supply is there. The demand is still there, thankfully, but there's much more supply than there is demand. And it's interesting when people talk about rent stabilization and rent control, you don't need that. What you need is somebody to get a shovel and to build apartments, and that'll take care of the rent control. You can do it with market forces, and we're seeing that in places like Charlotte, Austin, Phoenix, Nashville. These are all places that are oversupplied, and they still thankfully have population and job growth, but there's just much more supply coming on that there is demand right now.
Right. Yeah, I mean, everything, we're seeing a lot of different stuff, but one of the main differences, what I can, really easily say is between the 2008 to 2011 period to today is back then, the banks didn't have money and majority of the people didn't have money, but we're in a very unique situation being after COVID now. In 2026, banks are sitting on a lot of money, and a certain, I would say, top 10% of the population or top 5% are sitting on a good amount of money on their balance sheets, right?
Yes,
It's the
yes.
middle class that are getting squeezed a lot at this point for the cost of living.
I love that. You made a great distinction there. And I think it's important to make one more distinction of 2008 versus now. In 2008, to me, it was more of a residential market hit. I think people were speculating so much on condos and single family homes. There was a lot of houses underwater back then. Do you see that same problem now? I don't see that right now. I see so much equity in these homes, and I see low interest rates. I was just talking to my son the other day. We're going for a walk. He's 23 years old, and I'm just trying to make him understand what's going on with the market. I said, Michael, do you understand that almost half the houses in the United States of America don't have a mortgage right now? And I said, probably another 20 to 30% of those homes have refinanced in the last 3 or 4 years and have really cheap and low interest rates. So you have 70% of the population right now that doesn't need to sell if they don't have to. And that's the interesting thing right now. There's a dynamic where if you don't have to sell, you don't. But if you do have to sell, there are a significant amount of houses. 1 out of every 8 homes right now in the U.S. is in Florida. Listen, 1 out of every 8 homes that's for sale is in Florida. So there are certain markets that are getting hit a lot more than others. And I think that's what people need to understand as investors. Focus on the market that you're in and try to get as much knowledge and understanding of what's going on in your market specifically.
Right. I mean, Florida is one of the very, you hit it on it well, very unique ones, right? I was in Florida about 2 months ago in Miami going through Coconut Grove, and one of our good friends, client has a house there. He's like, let's go on the boat. And as we were driving, as we're taking the boat through these homes, 100 million, 300 million. So average price of a house was 100 million. Never in my life have I ever seen an average home at price 100 million amongst all these islands. And you're just like, really? It was like I sure it was like a daydreaming.
Yes. And this to me is what's beautiful about this state. When I came here 8 years ago, I prayed that I left New York. I just wanted to live in a fiscally responsible place. The governor of this state has lowered the budget over the last 4 years. So whatever we spent 4 years ago, he's decreased it. and if you think about how crazy it is, let's say, for instance, the budget was 120 billion in 2022. The budget's less today than it was 4 years ago. The population has grown and there's been significant inflation, and yet he's managed that growth and been able to actually cut. And how has he done that? He's done that because he's been intelligent enough to say, I want your wealth. I want you to come here. I want you to have $100 million home. There's going to be no state income tax. So if you make $2 million a year, if you were up in New York, you'd be paying 7 to 10%. I'm going to save you another $150,000 a year just to be here. I'm going to make it safe here. I'm going to make it affordable for you. And I'm going to make it a place that you can actually thrive and open a business. And I bet you, Cameo, when you were driving around, you must have seen a lot of strip malls. You must have seen a lot of building sites. You must have seen a lot of businesses that was going on down here. And especially in South Florida, that is becoming the mecca down there. Like, you are seeing a lot of financial capital coming from those markets, whether it's Chicago, whether it's New York. You have a lot of hedge fund money and a lot of people coming down there. And I mean, unfortunately, if you're an investor trying to buy a deal down there, it's challenging down there, but there is a lot of growth happening down there.
Between Miami Beach, and Palm Beach, I mean, let's talk about billions. Millions doesn't mean anything anymore.
It doesn't. It's incredible what's going on. And, I fortunately live in the northern part of Florida. So to give perspective, 80% of the population in Florida lives below Melbourne. So if you go to Melbourne, Florida, and you go below, 80% of the population is below there. I live in St. Augustine, which is in North Florida. So from Melbourne all the way up to St. Augustine into the Panhandle, to me, that's where the opportunity and the growth lie in this state. Pricing is still more reasonable up in the north part of Florida. I think it's going forward, there's more positivity because you're seeing insurance come down dramatically. What they've done with homeowners insurance has come down dramatically. What they're done with car insurance it's coming down dramatically. So the affordability of that is going really well. If this bill comes with property taxes as well for people who live here, that would be incredible if they can remove or reduce property taxes. That's the kind of innovative thinking that we need in this country right now, because we're seeing public school decline. There's actually less students going to public schools. So do we need to have as many public schools, or do we need to have as many people, employed there? Let's try to cut some of those costs and let's give that money back to the people. And once you give the money back to the people, they can spend it in any way they want, because it's going to go back into the economy. I'd rather have it go back from Cameo and from Gino into the economy than have it go back from the government into the economy. And I think that's what's leading this boom here. And I don't think in my opinion, it's going to stop, because once you have all the wealth coming here, and you have the jobs coming here, and you have the weather here, and you have the freedom here, and you have the stability of the budget here, that's what you want states to do. You want them to be fiscally responsible. And if they are, they'll attract capital. And once you attract capital, you attract innovation. And when you attract innovation, you attract jobs. And that's what spurs the economy.
Also, South Florida is a big crypto center for a lot of the crypto people.
I didn't know that. I didn't know that, but I wouldn't doubt it. I'm just interested to see how much longer Wall Street will become the quote unquote financial capital, where you need people to come into a certain area and say, hey, this is it. Because I grew up, I'm going to show you how old I am. In 1992, I went to work on Wall Street. I went to work for AIG all the way back then. And I remember it was just incredible driving down there. I worked on 99 John Street. You get out, I'm literally 2 blocks from Wall Street. The energy was incredible. I mean, it was just a completely different world. And now that I look back now, is that becoming irrelevant? I mean, are there other areas in the country like a Miami, like a Dallas, Texas, like an Austin, that now are becoming more the financial centers of the world? And I'm wondering how much longer New York can hold on to that, when all of a sudden we don't need it. It can be remote. It can be anywhere. It's just the ability to attract the capital. Almost like when you saw with Silicon Valley. Silicon Valley is one of those bubbles where you see all tech flocking to that area. And it was just the same thing with Wall Street. Now, is that being replaced with South Florida right now?
It is. I think there are multiple financial centers within the United States. Obviously, Wall Street is number one. It still is. How long would that last? Like you asked, it's hard to say, but there are multiples. I mean,
yes,
there's a population. It's a lot of money in this country.
Yes. Yeah, I
You
agree.
know.
I agree.
Now, so let's talk about about how what's going on in the economy today. We're like what 2, 3 months into the war. Rates are still at pretty much all-time highs relatively. We know that Mr. Walsh did not increase the prime, but he hinted there might be an increase. So that's kind of put a little bit of a scare. Whereas in the beginning of the year, before the war and everything, we thought we're gonna have 2 to 4, decreases.
Mm-hmm.
And now people are like holding on so that spending for corporate companies might get limited.
Mm-hmm.
As you briefly mentioned at the beginning, just like before we went on the podcast, getting a loan today versus 2, 3 years ago, the documents, the liquidity, even if the same bank has your loan and trying to refinance for you, how much harder and stressful that has become.
Mm-hmm. I want to say something, and I really want to stress this, and I want any buyer or any seller who's listening right now to take note of this. Debt is the circulatory engine of the economy. And what that means is if it's harder to get debt in a deal, it's going to take longer to close that deal. It may affect pricing. And so if you're a seller and you're looking for max price, and you're saying, I've got max price here, but I'm not sure about this buyer. This buyer is more secure. They're more financeable. They have more credibility. In this part of the market cycle, it may behoove you to take a little bit less to go with the sure deal because it is really hard right now to get a loan. I'm not saying it's impossible, but we've been doing this for over 20 years. The documentation that they're asking right now, 6 months of liquidity. I mean, they're asking for bank statements, not that they always don't, but personal financial statements, they are going overboard. They're looking at all the analysis here right now, and they're looking at these appraisals, and they are going through a fine-tooth comb, which they should. But 2 or 3 years ago, they weren't doing that. It was a lot easier to get a loan. So all I'm saying is if you're buying or selling a deal, if you're the buyer out there, understand that it may be challenging to get a loan. And if you're a seller out there, if you're sizing two different groups, the group that is more credible, that has done more deals, and that is more financeable, if there's a choice between one or the other, go with that group because I'm telling you right now, it is difficult right now to get a loan.
It is. It also depends which bank you go with. What's their balance sheet portfolio? What is their tolerance? Are they keeping it on the balance sheet or are they selling and just servicing the loan? Like, there's multiple factors also for these banks, but they're definitely more stringent right now. They're more careful. There's different signs right now. Some are going to say we're going to go into recession. Some saying a year or two. So they're just tightening up, obviously, right? And also they also have the yearly audits, right, with the federal government, right? If they don't hit the audit, they go on certain probations.
You made a great point, and that's true. You have to really look at every bank specifically because we deal with the community banks, we deal with credit unions, but we also deal with Fannie and Freddie. And Fannie and Freddie has sharpened their pencils. They want to make sure that there's enough requirements. If you're buying an old property, you better have enough reserves for the old property, right? So they're being very stringent. They're being very cautious right now. And that's how you can tell there's a different sentiment in the economy, in the marketplace, a different feeling. There's not the optimism that we had 3 and 4 years ago. Right now, I wouldn't call it pessimism, but I would just call it what you said. They want to be more stringent. They want to be more careful. They're lining all their ducks up in a row, and they want to make sure that everything works. And when that happens, that tends to slow things down. That tends to make things a lot tougher. A deal that could take you 30 to 60 days a couple of years ago, you got a budget for at least 60, if not 90 days right now. So that's also another thing that you need to be careful of. And you also need to be careful that when you have all your documentation, we have everything, get it as quickly as possible. And if you have multiple partners, you better make sure and tell your partner, hey, buddy, let's buckle up. I can't wait 2 weeks for your personal financial statement. I need it as soon as possible because Camille is not waiting. And then all of a sudden, we make him wait. Then the bank waits. You can't do that. Things have to get done quickly with urgency in this part of the market cycle. And I think that's something that we all need to understand as investors right now.
Absolutely. One thing you mentioned, Fannie and Freddie. Freddie's out of the market. There's no more Freddie for commercial. So it's only Fannie at this point. Will they come back? We don't know yet.
Will they? Is that the question?
Right. Exactly. And also for loans, which I always tell a majority of my clients, before you open escrow, get all, like you just said, get all your documents in a row, give it to the bank you want to work with or the broker you want to work with, and have them ready. So once you do open escrow, they're ready to submit. Like you said, they're not waiting to grab the PFS and the bank statements from you. Could that delay a 1 or 2 weeks? Will definitely delay the back end.
Mm-hmm.
I can
And
assure you that.
so what do you need? You need at least 2 years of personal tax returns. So get your tax returns, put them in a Google Drive. You want at least the last 3 months of bank statements. If you have any type of whole life policies, you want the cash value on your whole life policies. If you have your personal financial statement, button that up. Savings, checking accounts. You want to make sure that you have a schedule of real estate owned. Make sure that's up to date. And it can be overwhelming and it can be daunting. But guess what? Now that I told you this, you can start working on it piecemeal. And this is something, if you're an investor, you should have your schedule of real estate owned. That should be done monthly. At the end of the month, you know what the values are. It's pretty easy to calculate. And at least quarterly, it should be updated to make sure that the new mortgages are on there and the new valuations are on there. So then when a deal does come, you're not scrambling for all this documentation.
And only maybe 5% of the nation does that. Everybody else does that last second. I don't want
to time out. What's the percent of the population that's successful in the country or financially independent? 5%. And those 5%, the reason why is because they're prepared. Proper preparation prevents poor performance. That's the difference between someone who's successful and someone who's mediocre. That honestly is the only difference, other than having some knowledge and having some understanding and getting into it, making mistakes. But if you can be properly prepared, a deal lands in your lap and you can execute in that deal quickly nowadays. That's the difference between doing a deal today and not doing a deal.
Right. So it's funny. So we did a multifamily deal right here in Southern California. So it was a client of mine who had 2 other properties. Everything full out, right? We closed the deal 28 days for a multifamily.
Wow. That is awesome, dude.
A to Z.
That's like lightning. That's lightning speed, bro. Lightning.
But it's exactly what we're speaking about. Everything was ready. Everything is correctly updated. I mean, the bank's like, I don't need anything else. Let's go to underwriting.
That is awesome. That I don't want to say that's rare, but that is very uncommon, especially. Correct. But what's interesting, and this is the irony of what's going on with the economy right now. You would think that the lack of deal flow, these banks and these loan officers and the institutions would be hungry and would be more efficient. When in reality, just think of yourself. When you're having a slow day, you're not that busy. You take a little bit longer. You take a nap. You slow down. But if you've got your calendar filled, you show up, you're ready to execute. And that's what's going on right now. There's not much activity going on and they're just slacking right now. And there's no urgency, although there should be urgency because there's not any deals. So when you do get a deal, you should be pencils down, raring to go. And that's not the case right now.
Yeah, like you said, it depends on your character, your attitude, and what you're looking for in life, how you treat yourself, right? And how successful you're going to be.
Yes, I agree 100%.
But yeah, every person who has their ducks in a row always are getting more deals. I have clients, due, as I mentioned in the past, due to cost segregation, they have to buy 2 buildings a year. Otherwise, they're going to owe Uncle Sam. It's either pay Uncle Sam or do the accelerated depreciation and use what the money saved for other buildings.
I feel the pain. We're on that hamster wheel as well. It's a good problem to have, isn't it? But it is a problem to have because the thing is, no deal is better than a bad deal. And this is another thing that I love to tell everybody. If you're listening to this, this is super important. When you're buying a deal, you're not buying a deal just for the tax benefits. The tax benefits are the cherry on top. That's something that's really excellent. You don't let the tax benefits wag the tail of the dog, right? The deal has to be good. If the deal is good, the tax benefits are the benefit, are the bonus. But at the same time, we need to get the deal done. So that's why we need to be out there talking to brokers, doing property tours, talking to property management companies, talking to loan officers, talking to commercial banks, talking to credit unions, talking to loan brokers. These are the people who have the pulse on the market. These are the people you want to talk to. And the more deals you can look at, chances are that you're going to find one of those deals that satisfies the quality of your buy right criteria and then will also satisfy the tax side of the equation as well.
Right. Gino, let's hit on, what the war has done, right? We've been in this war, 3-4 months? Rates are still, again, as we mentioned, are high. there, in the beginning, definitely created a lot of uncertainty and people were on the sidelines. Now people said, we just have to continue with their life. And just in the last week, I know rates have gone up quite a bit. The 10-year bonds up, unless you're dealing it based on SOFR. And so, how does that affected your mindset and
Oh,
what
it
you're seeing out
sucks.
there?
It just sucks because we have the ability to refi millions of dollars right now, and we can't because rates are continuing to go up. So for me, it's just this lock. It's just like if we're able to get rates down, it's not even for buying a home. There's so much equity that's locked up in the markets. And I'm not blaming interest rates on valuations, although obviously there's a correlation. I'm just saying the sentiment itself. And it's also this feeling of uncertainty. Is this war going to be over? Obviously, they're decimated. Obviously, they've got nothing left. They shoot a couple missiles, and 20% of the oil flows through there, but 90% of the oil is bought from China. So does it affect us? We have an oversupply of oil. Venezuela is pumping more oil as we speak. There's so many other parts of the world that are pumping more oil. Plus, we're starting to divert from the Strait of Hormuz. So I don't think oil or gas prices in the long run are going to be affected by this. I think actually in the long run, this is a great solution because we don't have to use the Strait of Hormuz. There are going to be other ways to get oil out of it. So for me in the short run, but it does present challenges. It does present uncertainty, and markets don't like uncertainty. And it's interesting how they gave a pause with this memorandum of understanding. We gave like quote unquote a timeout and trying to be reasonable and saying, hey, let's see if we can come up with a solution. And instead, they continued their attacks. And I just think, unfortunately, we just have to go in there and we just have to finish it. The quicker, the better. And once we can do that, once we can just, calm things down, let traffic flow through that area, peacefully, and the next 6 to 12 months, find alternate ways to get oil out of that region. I think it'll be a foregone conclusion that they will not have the power that they have. That's their only leverage point. But how does that affect us? It does affect us with higher interest rates. It does affect us with higher borrowing costs. This directly affects the middle class because of home equity loans, because of credit card debt, because of car loans. Financing is a lot more expensive than what I think it should be. And that's the linchpin that we have going on right now.
Definitely. You said a little bit earlier, you mentioned about equity in people's homes, right? So it's very interesting. A lot of the loans that are being done today, because of the low rate people have on the first, they're getting HELOCs. A lot of seconds and HELOCs. No, they might be using the money to invest. Maybe they're using it just to get through this hard times. There's multiple different reasons, right? But a lot of equity out there and a lot of HELOC applications. I would say there's probably 60% applications are just for second loans and HELOCs versus first mortgages right now.
I'm wondering what they're using it for. Like you're saying, are they using it because the irony to your statement is I did a HELOC on my house because I had no mortgage on my personal home. I took out $875,000 and I bought a property. I bought a 68 unit last year. So I used it. I'm like, hey, the money's not sitting there. So it's costing me 5.75% to 6%. I'm making more on that with that property, right? And that was the whole idea is that property can't get refinanced out to pay my home equity loan. And if I was able to do that, I would just pay my home equity loan back off and I have the property. So that's the power. If you can use your equity wisely and invest the money instead of using it to go on vacation or whatever, that's the difference between people who are properly prepared. If there's an opportunity and you have the ability to access the capital, I would say, hey, if you have the understanding of what that exit strategy is, how you're going to pay that equity loan off, or even if there's a delta, if you can borrow and it costs you $2,000 a month, but you're cash flowing $4,000 a month on the property, then to me, that's a wise way to use debt.
Right. And that's what a lot of people did during the, after the COVID years, when the rates were in the 1s, 2s, and 3s. A lot of people cashed out, put the money on the side, and when the federal bonds were like at 5.5%, no state tax, the delta, was their gain.
Yeah, and I should have done that. I had another house that was no mortgage on it, and I'm like, should I take a loan? It would have been sub 3%. That would have been free freaking money. Absolutely. But hey, you live and you learn. You live and learn. Absolutely. I don't know if we'll ever go back down to 3. People are always saying never. I remember listening to somebody back in 2013. Elon Musk was talking about catching rockets from space, and this guy says that will never happen. We'll never be able to do that. When you hear somebody say that will never happen, just mark my words. There's always a chance of that happening. And I'm hoping, I may be wrong, but I'm hoping that rates one day go back down to the 3s because I'll know exactly what to do with that property.
Right. Yeah, we need another catastrophe or something very unique to happen.
You never know. That's right. That's
You
right.
never know.
A black swan event. You're 100% right. I agree.
Well, Gino, thank you again for your time and for the amazing expertise. And we shall be speaking soon.
Thanks, brother. Appreciate it.
Appreciate it. Thank you.
Thank you for watching. If you enjoyed this episode, please give us a thumbs up, subscribe, share any questions or comments in the comments below, and follow us on social media. I look forward to seeing you next time.
Let's get together. Let's get to having some fun. Let's do whatever. The night's looking so young. Let's get together. Let's get to having some fun. Let's get together. Let's get together. Let's get together. Let's get together.